Peter Lynch is a legend, a name that resonates with both seasoned investors and newcomers alike. He's a Wall Street icon, a figure who has left an indelible mark on the financial world. He made his name at Fidelity Magellan, where his investment strategies became the gold standard. This guy turned a small fund into a monster. We're talking billions, folks. His success was unprecedented. His secret? He believed in you, the everyday investor. He saw potential where others saw risk. Lynch wrote one up on Wall Street for you. This book is more than just a guide, it's a manifesto for the common investor. He wanted to empower you, to give you the tools and confidence to take control of your financial future. His message is clear. You can beat the pros. You don't need to be a Wall Street insider to succeed. You don't need a fancy degree. Lynch himself was a philosophy major before diving into finance. You don't need inside information. What you need is a keen eye and a willingness to learn. What you need is right in front of you. Everyday observations can lead to great investment ideas. This book is a game changer. It demystifies the stock market and makes investing accessible to everyone. It breaks down complex stuff into bite-sized pieces. Lynch uses plain language. He tells captivating stories that stick with you. This ain't no boring textbook. It's an engaging, insightful read that keeps you hooked. He wants you to understand investing. He wants you to feel confident in making your own decisions. More importantly, he wants you to succeed. So buckle up. Get ready to embark on a journey of financial discovery. Get ready to learn from the best. Peter Lynch's wisdom is timeless and invaluable. Peter Lynch is about to change the way you think about investing. Let's dive in and unlock the secrets to financial success. Wall Street can be intimidating, all those suits, all that jargon, but Lynch says, hold on, you have a secret weapon. You live in the real world. You understand consumers. You see trends before analysts do. Think about it. You shop at the mall. You see what's hot, what's not. You talk to your friends. You hear about new products. This is valuable information, folks. Wall Street is stuck in their ivory tower. You are on the ground floor. Let's say you love a certain coffee shop. The lines are always out the door. Their stock is booming. That's an opportunity. You saw it before the analysts caught on. That's your edge. Lynch says, invest in what you know. It's that simple. You have the power to uncover winning stocks. You just need to open your eyes, open your ears, and trust your instincts. Lynch breaks down stocks into 6 categories, each with its own unique characteristics and potential for growth. This categorization helps you understand their potential and make informed decisions. It guides your investment strategy, allowing you to tailor your portfolio to your financial goals and risk tolerance. He makes it clear, not all stocks are created equal. Each category has its own risk and reward profile. First, we have the slow growers. These are typically large, established companies. They pay dividends and provide a steady income stream. Think utilities and other essential services. They're steady but don't expect explosive growth. Next, we have the stalwarts. These are blue-chip companies. They're growing but not as fast as they used to. Think Coca-Cola, which has a strong market presence and reliable performance. They offer stability and moderate growth. Then we have the fast growers. These are the exciting ones. They're expanding rapidly and often reinvest their profits to fuel further growth. Think tech companies, which are known for their innovation and potential for high returns. They can be volatile but offer high returns. Now let's talk about cyclicals. These companies are tied to the economic cycle. Think airlines and automakers, which perform well during economic booms but struggle during downturns. They do well when the economy is strong but struggle during downturns. Next, we have turnarounds. These are companies facing significant challenges but have the potential to recover. They're trying to turn things around, often through new management or strategic changes. It's high risk, high reward. Think of a struggling retailer making a comeback. Lastly, we have asset plays. These companies have hidden assets that are not reflected in their stock price. Think of a company sitting on valuable real estate or other hidden assets. These assets can provide significant value if recognized and utilized properly. These assets are not reflected in the stock price, presenting an opportunity for savvy investors to capitalize on. Understanding these categories can help you navigate the investment landscape more effectively and make more informed decisions. Section 4, Know Your Companies, the cornerstone of successful investing. Lynch is big on research. He says, investing without research is like playing stud poker and never looking at your cards. You need to understand the companies you're investing in. Don't just rely on analyst reports. Dig deeper, read annual reports, visit their stores, talk to their customers, get the inside scoop. What are their products? Who are their competitors? What's their management team like? These are crucial questions. The more you know, the better decisions you'll make. Lynch loves companies with simple businesses. If you can't explain it to a 5-year-old, maybe it's too complicated. He also loves companies with a niche. They have less competition and more pricing power. Remember, you're not just buying stock certificates, you're becoming a part owner of the business, so choose wisely. Section 5. The PEG ratio, unveiling value in growth stocks. The PEG ratio stands for price, earnings to growth ratio, and it's a crucial metric for investors. The PEG ratio is a powerful tool. It combines the PE ratio with the company's growth rate, giving a more comprehensive view of a stock's value. It helps you evaluate growth stocks. By considering both the price and the growth rate, you can make more informed investment decisions. It compares a company's price to earnings, PE ratio, to its growth rate. This comparison helps in understanding whether a stock is overvalued or undervalued. Lynch calls it the single most important tool. Peter Lynch, a legendary investor, emphasizes its importance in his book, One Up on Wall Street. A PEG ratio of 1 means the stock is fairly priced. This indicates that the stock's price is in line with its growth expectations. A PEG ratio below 1 suggests the stock is undervalued. That's a buying opportunity. When the PEG ratio is less than 1, it signals that the stock might be a bargain. Let's say a company has a PE of 20 and a growth rate of 20%. In this case, the PEG ratio would be 1, indicating fair value. Its PEG ratio is 1. This balance between price and growth is what investors look for. Now let's say another company has a PE of 40 but a growth rate of 40%. Despite the higher PE, the growth rate justifies it. Its PEG ratio is also 1. This shows that even with a higher PE, the stock can still be fairly valued if the growth rate matches. Lynch argues that growth should justify a higher PE. He believes that a higher growth rate can warrant a higher price-to-earnings ratio. The PEG ratio helps you find those hidden gems. It uncovers stocks that might be overlooked but have strong growth potential. It's not the only factor, but it's a great starting point. While the PEG ratio is valuable, it should be used alongside other metrics. Remember, growth is crucial for long-term returns. Investing in companies with strong growth prospects can lead to significant returns over time. The PEG ratio helps you separate the true growers from the overhyped ones. It allows you to identify stocks with genuine growth potential, avoiding those that are merely hyped up. Section 6. Time is your friend, embracing a long-term perspective. Wall Street is obsessed with short-term results. They panic over every blip in the market. Lynch says, ignore the noise, focus on the long term. He says, time is the friend of the wonderful company, the enemy of the mediocre. Great companies take time to flourish. Don't expect overnight riches. Be patient. Let your investments compound over time. The stock market is like a roller coaster. There will be ups and downs. Don't panic sell when the market dips. Remember why you invested in the first place. If the company is still strong, hold on tight. Lynch's advice? Buy right and sit tight. Find great companies at reasonable prices. Then, let time work its magic. Compounding is a powerful force. It can turn small investments into significant wealth over time. Just give it time to work.